welcome back. It's another episode of What's Trending in CTA, the Simplify Managed Futures Strategy ETF. And as usual, I'm joined by Charlie McGarrah, who's the Chief Investment Officer at Altus Partners, the Futures Advisor to CTA. And we are back to share some, I say, positive news, positive performance for the month of April. It got a little choppy there in March. If you guys didn't catch our March episode, definitely go back and take a listen on that. But let's dive into the month of April here and share some of the really strong returns that we've seen recently, and as well as the year-to-date period. Charlie, can you see my screen?
I can.
Cool. All right. We're off to a good start. Okay. So this is going to be a longer term snapshot of CTA going back to the inception, which was March of 2022. We passed our 4-year anniversary earlier this year, put out a nice piece on our website if you guys want to go back and take a look at that. That just kind of speaks to the strong investment results that we've seen from both a return perspective, and you'll see here through the month of April, annualized returns on CTA have been about 12.6%. And I think this is really important to stress because oftentimes, again, we talk about in order to have low and even negative correlation to traditional assets, oftentimes that means you might be sacrificing in return. CTA has delivered both the intended objective, which is low correlation to traditional assets. You'll see that here in the middle of the slide, negative 0.22 correlation to the S&P 500 since we launched, negative 0.35 correlation to the aggregate bond index. And all of this with, again, a 12.6 positive total return. So it's the hedge that you get paid to own, as we like to refer to it as. And then lastly, I would say, just because it's been very topical in the last couple of weeks, and we'll speak to this in a subsequent slide, because of some of the greater exposure and emphasis to some of the commodity markets, the question often becomes like, how does this play alongside a strategic or kind of a longer term commodity allocation? And because of the dynamism of CTA being able to be fully long, short, and the more flexible positioning that's moving around, we've only seen about a 0.15 correlation to the Bloomberg Commodity Index since inception. So that will, of course, fluctuate. We talked last month about some of the outsized position in oil and energy, which persists into the month of April and even now into May as we're recording this. But really the ability to see this as another liquid alternative alongside strategic commodity beta in a portfolio. And that's how many of our clients and investors use it. The other thing I might mention too is from a return objective, thinking about the ability of CTA to deliver in the good times of equity markets trending higher as well as the bad times. And oftentimes trend following gets termed crisis alpha. And you'll see in this last kind of row here, when the S&P 500 has had a positive monthly total return since we launched CTA, CTA has delivered a 0.6 positive return. So a little bit of this kind of maybe lower returns than equities in a trending up market like we experienced in the back half of 2025, but still positive return. And then more importantly, when we do see those negative monthly returns for the S&P 500, CTA has more than delivered with an average monthly return of 2.28% in those periods. So a little bit of asymmetry there and some of that kind of upside potential when we see a sell-off in markets. Just for those of you that may be new here, CTA is unique from other trend following managed future strategies in that we are focused on interest rate and commodity futures. So you will not see equity futures, you will not see foreign exchange or currency futures. And that was a intentional design feature at launch to really provide that maximum diversification through the strategy. This is one of my favorite charts. If you guys aren't already aware, the nice zigzag pattern that you see, the black line is CTA back to the inception. The gold line is a 60-40 portfolio. We always like to say it's not necessarily about what line is on top, although you'll see the black line continues to lead a 60-40 portfolio, but it's really the pattern of these two lines moving together. And this is I would say, a simple expression of that diversification. So we talked about CTA having a negative correlation to a 60-40, and this is that proof point. So as a 60-40 portfolio sells off, CTA does quite well and vice versa. And you'll see in just the last couple months on the far right of this chart, the exceptional performance from CTA. And we'll talk a little bit about that. And the next slider here is what's driven some of those outsized gains that's led to this strong performance. So jumping right in then, this again is through the end of April. CTA maintains its 5-star Morningstar rating, and that's within the systematic trend category at Morningstar, which has about 60 plus peers. So proud of those investment results. You'll see the trailing 3-year, we're in the top decile of our systematic trend peers per Morningstar. The 1-year number, we're about median return. Some of that turbulence was driven by some kind of mid 2025 returns coming out of the tariff tantrum, but really the last 3 to 6 months, we've seen really stellar returns. And then on the right here, you'll see the quarter to date, which is also just a 1-month trailing period. It's just the month of April. And some of those strong gains in the back half of April, as we saw Brent energy oil broadly rise with some of the tensions in the Middle East, and the outsized position that CTA has held within Brent has been a key reason why we've seen these strong returns. So I will loop in Charlie now just to maybe talk through some of these specific drivers. This is the monthly review that we give of attribution. The quarter to date period, again, is just the month of April. It's the second quarter period. And then you'll also see year to date. And I just want to emphasize the total return that CTA has experienced through the end of April for the year to date period. Exceptional environment for liquid alts and for trend following broadly, and CTA has led the pack. So Charlie, if you wouldn't mind sharing some of the drivers of that would be great.
Yeah, I think it's been a pretty wild market in energy with the headline ping pong on the war. Is there a resolution? Is there not? And that's really been the main driver of the volatility in this strategy is just energy markets. We've had a decent run in oil and distillate products, gas, heating oil, and oil itself. But it's really a case of energy volatility. There's been some incremental, I would say, price action in metal that was a little bit whipsaw-like as the market can't quite make up its mind on gold and silver, and they're kind of just trading with a range but nothing really to write home about. And then we've also seen some decent performance in live cattle from just trending price action, the ongoing drought in the U.S. and a herd that is very small is just continuing to put a bullish spin on the cattle futures market, and some trending price action. Interest rates and related bond product have just been pretty boring. They're kind of moving in lockstep with oil, and it just seems like that's a better way to portray the view. And then looking ahead, probably more of the same. You can never say what could drive a market. Anything can happen, of course. But as it stands right now, to me, the most fascinating dynamic in the energy markets is this question of is oil a financial asset where people express opinions about the probability weighted possible outcomes, or is it a physical asset where supply and demand actually have to clear and inventories have to be destocked and restocked? My strong view is that the oil market has not yet priced the possibility of an actual supply shortage. We've got a willingness to destock inventories. I think that has surprised me at least, and smoothed over some of the price action. But it just feels like with every passing day that the supply deficit remains. Eventually it may turn into something more. So we shall see. But the trend is up still, it feels.
Super helpful. And maybe one other kind of side comment I would make, just given some conversations I've had with clients over the last couple of weeks, especially around metals. We saw such a strong rally in that space in the back half of last year, and then even through January of this year. And I know many investors and advisors are holding dedicated kind of standalone allocations to both gold as well as silver. And oftentimes I'll get the question of how do you pair CTA, which can hold or does hold gold and silver. And I would just say, again, the beauty is that in a more dynamic strategy like CTA, which can go both long and short, it tends to be a complement or diversifier from your standalone position. So this kind of goes back to what I mentioned at the onset of today's discussion, was that correlation to the Bloomberg Commodity Index. Even if you hold, say, precious metals strategically, CTA can enhance returns and ultimately will give you the allocation to gold and or silver if that's what you're seeking when there is positive price trend. So when there's not, CTA can also kind of offset maybe some of the drag from a dedicated gold or silver allocation. So just wanted to highlight kind of more how to use this in practice.
Yeah, precious has been tough because it's like, on the one hand, it's a savings asset in global emerging markets, and with an oil shock, they need to fund consumption. And it's, makes sense that you'd sell some of your savings assets to pay for the basics of life's necessities, namely food and energy. Um, on the other hand, this oil shock is probably not great for petrodollar reinvestment in kind of global macro and the dollar long term, and perhaps a dollar diversifier is there. So I think the market's kind of caught between a sort of push me, pull you. On the one hand, it's like, yes, we've got to liquidate and re-rate consumption versus financial assets, and on the other hand, it's sort of like a de-dollarization thing seems possible, and that would probably be bullish precious. And I don't think we've seen the market make up its mind yet, and maybe it'll be a bit of both for some time to come.
Yeah, I would say too, kind of going back to some themes I've been parsing out in client conversations is, and I know Charlie, you would feel strongly about this, is that hard assets broadly are still like very much underrepresented within broader portfolios. And so I think a lot of allocators and advisors are just starting to understand like maybe this wasn't just a short-term play because of some sticky inflation post, COVID or post 2022 stock bond correlations, but really introducing hard assets within a strategic allocation within portfolios and not just through commodities. A lot of discussion around reshoring and infrastructure as well. So
Yeah.
I think
I
this is
mean, I
an
think
example.
that is such an important point because the market's obsessed with the sort of deflationary impact of AI and this amazing sort of productivity boom and downstream technological value add. But it's like in life, there's a long cycle between innovation and the bottlenecks to innovation. And the bottlenecks to innovation, yes, they are molecules like metal, copper, nat gas, oil, all this stuff. So there are molecules and energy, but they're also land and infrastructure. And so again, this upstream, downstream, where's the pricing power in the economy going to be? I'll be the off consensus guy and say I think it's in this hard asset and supply side put cost push inflation. But maybe you'll prove me wrong with your awesome AI optimism. But in the meantime, I think you should be buying hard assets. And so of course, that's what I built my business around. So but I also think it's true.
Yeah, I think a big theme too, even with the AI push, is that we need the data centers to support that, which becomes a hard asset push as well through infrastructure. So
Yeah,
it's all interrelated.
energy and water upstream.
Yep.
Yeah.
Um, Okay, great. Well, I think those are most of our comments here. I know in the past, sometimes we skip over this, so I just wanted to let this slide linger on screen for a bit. This just shows month on month for the last trailing month end periods of April, March, and February. Across this slide here shows all the commodity exposure you'll see on the far left. These are sorted from the most recent month, greatest exposure or long exposure on the left to the lowest or least exposure on the right. And you'll see here Brent crude for the last 2 month end periods has had the largest allocation from a long perspective. We talked about that last month and again this month. Cattle has been represented in the last 2 month end periods as well. Both of those have been tailwinds to performance. And then you'll see on the far right some of the more of the soft commodities like cocoa, coffee, sugar have kind of been neutral to short positions. And those have just been kind of not seeing strong price trends in that space. And then lastly, from an interest rate perspective, obviously, I'm sure many of you are looking at this February month end bar here, which was in the German 10-year. Really, since kind of the beginning of March and into April, interest rate exposure in the fund has been fairly muted. I would say overall neutral. We have a couple longs, couple shorts, but really the story for the last 2 months has been commodities, and more specifically has been oil energy, just given all the tensions in the Middle East. So with that, thanks everyone for tuning in again. Thanks, Charlie, for joining me and providing your expertise. And we look forward to any questions. You guys can always reach out to us directly. I always say that nobody does. Last month, we actually did have someone reach out. So please do. Happy to jump on a call and appreciate all of your support.